Let's get started here. The key is really to look at how to prepare and be ready for the biggest investment of your life, because yes, buying your own home is an investment ultimately. Of course, those of you that know me, I do a lot of speaking about real estate investing as well, and I'll be talking a little bit about how real estate is an investment. But really, the focus of today is for most first-time home buyers. You're usually looking at buying your own home because of a number of different reasons, and primarily it comes about, yes, your wealth would be typically higher by owning your own home as opposed to paying rent. However, the other part of it too is things like control and not having to be at the mercy of your landlord. So welcome to the presentation today, everybody. Thank you for coming out. The first thing I want to talk about is why home ownership, and the reason for home ownership really is that it's one of the easiest ways to build your wealth. Investing can be difficult, investing can be hard, but when investing by buying your own home, it's one of the easiest ways to build your net worth. And so let's talk a little bit about some of the reasons that home ownership is one of the easiest and best ways of building your wealth. The first thing is it's a forced savings account. I know a lot of people who are pretty good with money, but unless they are forced to save money, it doesn't happen. And in fact, there's a saying out there that it's called "pay yourself first." Now, what that means is that most people, what they do is they get paid, and then they spend their money, and then they save the rest. And what should happen is you should actually reverse that. You should actually save first and then spend the rest. And they call that saying "pay yourself first." The nice thing about home ownership is that it's almost like a forced savings account. Canadians in particular are very, very good at making sure that they are able to pay their bills on time. And so paying a mortgage is essentially a forced savings account, because when you have a mortgage, you're making principal and interest payments down on that mortgage, and a large percentage of your payments are actually going down towards the principal. So it's forcing you to save money by paying down your own personal mortgage. Another thing is that the payments are building equity. So depending on where interest rates are, I've seen this anywhere from only 9% of your payments going towards the principal, all the way up to about 66% of your payments going towards the principal. It depends on the interest rate and the amortization that you're taking. As an example, interest rates that are as low as 1.5% on a 25-year amortization, about 66% of your payments are going towards the principal. When interest rates were closer to 6%, and you can get a 40-year amortization with zero down, and yes, that was the details of my very first deal when I bought my own residence when I was 19. You could get a zero down deal, 40-year amortization, and rates were around 6%. 9% of my payments went towards the principal. So you can see that the interest rates have a very large impact on the amount going towards your payments and your equity. And so one of the things we look at a lot is, well, is home ownership the right move for you, yes or no? And often it comes down to where you're buying. One of the most important things, however, is looking at what is the total cost of ownership going to look like. And in many cases, owning is a little bit more expensive per month than renting is. But if you factor out the amount that you're paying down towards the principal on the mortgage, which is essentially you with your forced savings account, you're often in a situation where your net cost of ownership, the amount that you're flushing down the toilet every month, is way, way cheaper. Especially when you consider the next item that I have on here, which is that on average, home prices generally will appreciate. When I model out and look at where I think and expect home values to be in the next 5 or 10 years, in general, you look at about an average of 3% annually per year. Of course, some years it's zero, some years it's negative, some years it's 30% appreciation. However, if you're looking at a major urban center, in general, the appreciation rate is quite good there, and you can bank on it being about 3% annually per year in most urban centers. Of course, you're looking at Vancouver, Toronto, etc., you'll find that the average appreciation of the last 25 years is probably closer to 6% or so. And what often happens is appreciation is fairly flat, and all of a sudden it spikes up, and appreciation rates all of a sudden jump up over a 1 or 2 year period by 10% or more. But in general, the average home price will appreciate in most markets in Canada. Another cool thing is that you can actually borrow against the equity, and the leverage aspect is a very, very important key here. So unlike most other investment vehicles where you can get in real estate, you can get up to 95% financing. It's very difficult to get that kind of leverage investing in any other tool. So when you're buying stocks, for instance, even if you're using a margin account and doing a number of things, you're usually not getting more than about 70% leverage, and that's if you're really pushing it. Whereas if you're buying real estate, you're able to get up to 95% leverage if you're buying your own personal residence. And here's another thing, it's less of a wealth building item, but I think it's very important too to understand is that when you own your own home, you have control. You get to control where you live. And for those of you that have been renting or renting right now or have been renting for the past, you probably have experienced a situation where you're living in the home. All of a sudden, a new buyer comes in and says, "Sorry, we're actually going to be using this place ourselves," or for whatever reason, the seller or the owner of the property is asking you to leave the home. And so there are many circumstances where people are forced to move out of their living situation where they've been renting and have been enjoying the home for a number of years. But the reality is, unless you own the home, you don't really have much control over that property. And so, for many reasons, people are looking at wanting to buy and own their own home so that they don't have to be moving around so much. And frankly, moving kind of sucks. It's not a lot of fun. So that's something that people are trying to get a little bit more control over. Now, there's a few benefits of being a first-time home buyer that are specific to being a first-time home buyer. So if you're not a first-time home buyer, these don't apply to you. But I do want to go over this really quickly with you and give you the three major benefits of being a first-time home buyer. And the first most important one is that you can withdraw up to $35,000 for each individual buying the property out of your RSPs tax-free. So you have to repay the money over a 15-year period. But this is a really important key because a lot of people have been saving their money by putting it into RSPs. But when you buy your first home, you can take out up to $35,000 out of your RSPs. You have to repay the money over a 15-year period. So this is a really, really cool a way of being able to access some of that money that you've been saving up in your RSPs, especially for those of you who might have a work plan where your employer may match or contribute a certain amount to your RSPs alongside you. There's another tax benefit here too, which is that you can get up to a $750 tax credit on next year's taxes. So when you file your taxes, as long as the government continues to offer this, there's a first-time home buyer incentive where you can get up to $750 off on your taxes the next year. The next one is no property transfer tax up to certain prices. And so many different provinces have a property transfer tax. In BC, it's a little bit different than it is in Ontario. In Ontario, for instance, they have a Toronto property transfer tax and then an Ontario transfer tax. You have to be careful about that. Manitoba has a property transfer tax. Alberta, for instance, does not have a property transfer tax. So in BC, as many of us are located in BC, there is no property transfer tax if you're buying your first home up to $500,000. If you buy between $500,000 and $525,000, then you pay a percentage of the property transfer tax. And over $525,000, you pay the full amount of tax. So that's one of the major benefits because just on a $500,000 property, for instance, the property transfer tax in BC would be $8,000. So it's not a small amount of money that we're talking about here. One thing I will also mention, by the way, guys, is I will open up for questions at the very end, and so I'll make sure that I answer any questions and stay until everybody has all of their questions answered. Now, if you're not convinced that home ownership absolutely makes sense for you, I am a spreadsheet guy. I definitely like looking at things from an analysis perspective. And so I created a rent versus own analysis tool. It's a spreadsheet. You can see that my beautiful face has been stretched out to fit this photo. not my finest moment. But on this spreadsheet, what you can actually do is you can punch in what you currently pay in rent and what your rate of savings is, so what you're earning on your investments, and you can punch in what the purchase price would be to buy that same property. And keep in mind, it's very important that you compare apples to apples. If you're living in a condo right now, renting a condo that's worth $300,000, don't compare that versus buying $1 million condo to live in. Those aren't comparing apples to apples. So you want to make sure that you're comparing what you're currently renting versus what it would cost to buy that same property, because now you're using the same living situation across both situations. And what it'll do is actually look at total purchase price, total costs in general. There's a difference between home ownership costs and renting costs. And so it actually takes the difference of how much money you'd be able to save if you were still renting and putting that into savings. And you would be surprised how much you'd actually have to see that home values would have to appreciate in order for you to have a higher net worth after 10 years. The answer is very little, actually. So when I've done this analysis, and it definitely varies on the type of property and mortgage rates at the time, et cetera. But when doing this analysis, in many cases, if you assume 0% annual real estate appreciation, you'd be having to make about 9% return in your stock portfolio for you to have the same net worth after 10 years by continuing to rent and then just taking that difference and pile driving that into investments. And the flip side, if you assume about a 3% annual appreciation in real estate values, then all of a sudden it gets very skewed towards home ownership, and you'd have to be earning about 18 or 19% every single year in your stock portfolio for you to have a higher net worth after 10 years, just renting and investing in stocks as opposed to buying your own home. So makes a really big difference. That spreadsheet is available on my website for anybody that wants to download it, and it's a cool tool. If anybody needs any help with running the numbers, our team's here to help you. So one of the important things, if you've decided, you know what, I think I want to learn more about this, let's look into home ownership. Let's figure if this is the right thing for you. The key is to get prepared. There's lots of work to do. So let's look at what that looks like. Number one, getting prepared and going through this. So the first thing is starting to save. A good way to figure out how much, or a good way to save is to figure out how much your total cost of ownership would be to buy what you want to buy versus what you're paying in rent right now, and just save the difference. Sometimes I have clients that I'm not so sure if they're ready to be a homeowner just yet, and I'm not sure if they have the ability to have to be able to make sure that they can afford their mortgage payments on a monthly basis. And so it's important to make sure that you're setting enough money aside so you can say, look, I don't have any payment shock. I actually know how much my monthly payments will be to own versus what it's costing me right now to rent. And so basically, if total cost of ownership is $2,500 per month, and right now your rent is $1,500, then you should be saving $1,000 a month. And if you can do that consistently, then you know that home ownership may be something that you can afford. And it's also a good way of building up your down payment very quickly. Make sure your credit is in good standing. Nowadays, it's pretty easy to know what your credit score is. Of course, if you're going through a mortgage broker or bank, they usually will be able to tell you or give you an idea of what your credit score looks like and whether it's good or not. Ideally, you want your credit score to be over 700. So just make sure that if you're starting to prepare for home ownership, make sure that you're watching your credit rating. Many banks now are offering free credit reports online on the online banking. So feel free to use those services. When you pull your own credit, it's called a soft check, and it typically isn't hurting your credit rating. And of course, getting connected with a good mortgage broker to get your pre-approval. Does anybody know any good mortgage brokers around here to get your pre-approval? I may have a couple names for you. Anyways, well, let's talk a little bit about why use a mortgage broker at all, because of course you can go to a bank yourself and do the shopping yourself. One of the benefits, of course, of using a broker is that mortgage brokers will shop over 40 different lenders to find you the best rate and best product. And probably what the best part about using a broker is the brokers are actually paid by the lender, since inside of the broker channel, there's very minimal cost for the bank because they only pay the broker if the deal actually funds. And so there's not a lot of overhead costs. They have 1 or 2 head offices that handle all of the underwriting, where they maybe have 40 staff or 60 staff or whatnot. And they do as many mortgages across Canada as all of their branches combined. And there's a lot of overhead that comes along with branches. They have a lot of employees getting paid whether they do business or not. And the reality is that the mortgage broker channel is a little bit more, well, I should say a lot more efficient, because brokers are this filtering system or pre-screening system. So brokers only send deals to banks if it's likely to fund. I know that in our office, about 90% of the deals that we send to a lender are going to fund. Whereas if you go to the branch channel, a lot of people are inquiring and kicking tires, and only about 30% of those inquiries turn into a completed transaction for the branches. So different business model, and that's how the lenders are able to offer mortgage brokers extremely aggressive rates, especially for first-time home buyers. You'll find that when you're buying your first home, that's really where the banks are very competitive. And insured, a CMHC insured mortgage, which I'll talk about in a little bit, is a very highly coveted type of mortgage that banks like to lend on. And so it's very easy for us to get extremely aggressive interest rates for first-time home buyers. In fact, first-time home buyers will typically get a better rate than their parents who are putting a larger down payment down, simply because an insured mortgage is a very profitable mortgage for the banks. One nice thing about working with brokers is there's no bias, no negotiating. You don't walk into the branch, get offered this rate, and then have to negotiate and figure out what kind of rate you're going to get. One thing that I always mention too is that brokers are always shopping for you, and so if the lending guidelines and lending interest rates change and drop, we're going to say, hey, you know what? The lender across the street just dropped rates. Let's use that and leverage that against the lender we already have your approval with, and try and get you a better rate. Or if they won't, then we'll take you to the other lender. We have all of your stuff already. Whereas it would be incredibly interesting, and I doubt this would happen, for a bank to actually say, hey, Joe, by the way, the lender across the street has a better rate. I think you should go over there. So there is no bias with us. It doesn't really matter which lender we send you to. Our objective and goal is to get you the best rate and also the best product. The other key is that we specialize in doing mortgages. This is all we do. When you deal with somebody at the branch, they often do RSP loans, they do banking, they do a number of other things. And the reality is that if you're a specialist in something and this is all you do all day long, especially if you're working with the top broker who just does mortgages, they're going to be really good at the job and know what they're doing and be fast and efficient. That's not always the case. It's just like anything, though. There are good mortgage brokers and bad mortgage brokers who don't do a lot of business. There are also good branch reps and not so good branch reps. And so the objective here is not to poo-poo on branch reps at all, but just to show the differences between brokers and branch reps. The other thing is for mortgage brokers, we're very mobile, flexible, and we are with you for life. The reality is that no matter what, we don't get promoted and move to a different role or a different situation altogether. A mortgage broker is here to help you and help guide you through your life goals and work with you. I find a lot of the time, and I've had this happen to me all the time, I have a good branch rep for a little while. They're good, but then all of a sudden they get promoted and I have to start from scratch with the kid who just graduated from college, and I've got to start that process all over again. So I do find that can be a little bit frustrating sometimes dealing with the banks. So let's talk about the elephant in the room here. Getting a mortgage, it's not the most fun thing ever. For those of you who have gone through this process and tried to obtain a mortgage, it really isn't that fun. Our role in the process is to try to make it as easy as possible, as easy as it can be. It can be very overwhelming and challenging, especially the amount of paperwork and documents that are needed. I will say this, first-time home buyers, you've got it easy. And when I say that, our real estate investors will know what I'm talking about. If you're a real estate investor with 5 or 8 rental properties, the amount of paperwork that we need for that person is probably 100 to 200 pages worth of documents. If you're a first-time home buyer and you're pretty clean, salaried employee, we might need 6 or 8 documents from you, not a whole lot of stuff. And the process can be pretty smooth and simple. So, at Green Mortgage, we try to make it as easy as possible. We not too long ago launched our what's called a roadmap. It actually guides you through the process, and it tells you this is what stage you're at right now. This is what the timeline is looking like at this stage, and this is what the next stage looks like. And so our customers actually get an email. It's a slightly different version than what you see here, and you see an email that comes out and says, "Hey, this is where you're at now. This is the next stage that you're going to come up to." And just try to hold your hand and guide you through this process because we know how overwhelming it can be to buy your first home. So let's talk, and I want to highlight the pre-approval part of the process because this is a very important key. The pre-approval does a couple of things for you. So the most important thing is letting you know how much you qualify for. You don't want to start going shopping and looking at homes, wasting your realtor's time or your time looking at homes that are outside of your price range. It's really important that you know how much you qualify for. The other thing that's really important with getting a pre-approval is that we can hold rates for 90 to 120 days depending on the lender. So this way, while you're shopping, if rates start to go up, we can still hold an interest rate for you. And that way you get the best interest rate that happened in that 4-month window. And that's a great way of knowing exactly what your worst case scenario budgeting is going to look like. So we tell our clients all the time, make sure you get a pre-approval, make sure you know exactly what your worst case scenario rate is, budget based off of that. Of course, if rates drop and get better while you're shopping, great. But if they don't and they start to go up, at least you know what your worst case scenario is. The other thing that's really important here is you have to be prepared so you can put forth the most attractive offer possible. So if you're selling a home and you have a number of different offers to choose from, if you have one offer where the buyers say that they need 3 weeks for financing because they don't have their stuff together and they don't have their pre-approval done yet and they have to prepare everything for their bank, or they have another offer that has a 1-week subject removal on it, where all of the subjects for financing, for inspection and things like that are only 1 week, because that person has their pre-approval already in place, that offer is more attractive to that seller. You have to watch out, especially in really hot markets. In some cases, you even have to be maybe writing subject-free offers, which is really, really crazy, especially for a first-time home buyer. This is your first go at it. But if the market's really hot and the seller has 20 or 30 offers that they're looking at, well, they have their pick of the litter. And one of the ways to be more attractive is not just the price, but also the terms. And the more prepared you are, the more you can compete on the terms in your contract. And so it's really important to make sure that you're organized in advance and you have that pre-approval set up. I want to talk a little bit about qualifying for a mortgage because there's a lot of misunderstandings and clarification that I think that should come about this, just to help people understand how exactly do you qualify for a mortgage and what are lenders looking at. So the first thing is credit. If you're getting a mortgage, and especially if you're putting less than 20% down, your minimum credit score needs to be at least 620, but even that, it's really pushing it. It's really tough to get a lender right now to finance somebody with a credit score of 620. Ideally, you want it to be 680 or 700 plus. So it's really important you take really good care of your credit. Some things that you should be doing is making sure all of your payments are made on time, making sure you're not going over limit on your cards, make sure you're trying to borrow less than 50% of the balance in all of your credit, and making sure that you're not shopping around for credit too frequently. When you have credit inquiries on your credit score, it will have a small negative impact on your credit rating. Now, it's not as big as missing a payment. For instance, a credit inquiry is usually about 1 to 5 points negative on your credit score for a little while. If you miss a credit card payment, on the other hand, it could be about a 100-point drop on your credit rating. So keep that in mind, but it's very important to maintain good credit, especially while you're starting to get going and start shopping for a home. Income. So I'm going to cut to the chase here. Income is the number one thing that the lenders are looking for. Credit is very important. So if you've met that hurdle, then this is the biggest hurdle for most people, and it's the income. So the lenders are looking for what's called a debt servicing ratio of 44%. What that means is that if your income annually is $100,000 gross before taxes come off, so that would be your T4 income, for instance. If you would make $100,000 a year, the lenders won't want more than about 44% of that income to go towards all of your debts. Now, this math can get a little bit complicated, especially if you're trying to break down everything. I'm going to give you the really easy version, okay? Because the math works out the same if we do it this way. If you have no other debts, so no car loans, no student loans, no credit cards, etc., for every $20,000 in income you have per year, you'll qualify for about $100,000 in a mortgage. So if you make about $500,000, you make about $100,000 a year, you can probably qualify for a mortgage of about $500,000. So that's something to keep in mind. Down payment. So the minimum down payment is 5% down. Now the government, of course, had to make this a bit more complicated on us a couple of years ago. And the down payment structure is 5% on the first $500,000 and it's 10% on the remainder. Meaning that if you bought a property for $600,000, your down payment will be 5% of $500,000, which is $25,000, and then 10% on the extra $100,000 from $500,000 to $600,000. So that extra 10 grand on top of $25,000, that's a total of $35,000 down for your down payment. So again, it's 5% down in the first 500 grand, 10% down on the balance. Now, an important key here is that if you have less than 20% down, you need mortgage insurance. There are three mortgage insurers in Canada. I'm going to get into some details in the next slide to talk about that. One important key is that if you buy at $1 million or more, it requires a minimum of 20% down because you cannot get insurance, mortgage insurance on a home over $1 million. For some reason, $1 million is the cutoff, and if you live in Vancouver or Toronto, it's a pretty low cutoff and a pretty low bar. But for whatever reason, the insurers decided they don't want to be insuring properties that are valued at over $1 million. Here's one thing that I want to talk about, because this is the often forgotten item, and I get this question a lot. I'm pre-approved. Can't I just write an offer without subject to financing? Why do I need to write an offer with subject to financing on it? Why am I not fully approved? The reality is that the property is a very important key to the entire transaction. That's the security that they're getting. Sure, there's you, but the whole reason that you can get 95% financing at extremely low rates is because it is real estate backed. It is secured by the real estate asset, and it's registered on your title. So a couple of things that are key to understand here is that the property should be in good shape and it should be marketable. There shouldn't be any issues. So if you see properties that are very unique or different, a couple of items to watch out for are co-ops or leasehold properties, like properties that are on native lease land, and depending on where you live, that can be common or not so common. But anything that restricts the marketability of the asset can make it harder to get financing on it because it's harder to sell. So the lenders do look at, well, where is the property? Is it in a small town where there's not a lot of buyers and sellers, or is it in a big city where there's lots of buyers and sellers? So they're always looking at the marketability of the property and how quickly, if they had to foreclose on your home, how quickly can they get in there, take over the home, and resell it and get their money back. The banks aren't in the business of owning real estate. They're in the business of lending money on real estate. So about the mortgage insurance, what ends up happening is if you put less than 20% down, your mortgage has to be insured through one of the three mortgage insurers. There's CMHC, which most of you probably know or have heard about, and that one is Canada Mortgage and Housing Corporation. That is a Crown corporation. And there's also Sagan, which used to be called Genworth, and another one called Canada Guarantee. So those three mortgage insurers are the three options that banks go to get mortgage insurance. And mortgage insurance doesn't actually really protect you. This is not mortgage insurance where if you get injured or sick, it will cover your mortgage payments for you. This is strictly just to cover the bank if you go belly up on your mortgage, they foreclose on you and they lose money. See, with only 5% down, there's not a lot of equity in the home. So if the values just drop a little bit and then you stop making payments and the bank's not collecting any money and then you don't pay your property taxes, etc., you could be very underwater. And so mortgage insurance exists so that if that happens, the bank gets to recover their losses, and you, the borrower, have to pay for the CMHC insurance premium. So this insurance premium gets added to your mortgage. So it's not an out-of-pocket cost, but it gets added to your loan amount. So if you put 5% down, they add 4% of the loan amount back onto your mortgage. You're effectively borrowing 99% of the asset value. You know, if you bought a $100,000 place, which is, of course, not going to happen in most areas for, where most of you are tuning in from. But just to make the math easy, if you bought a place for $100,000, put $5,000 down, that's a $95,000 mortgage. You'd add the $4,000 CMHC premium onto that, and you'd be up to about $99,000. So it's not quite $4,000 because it's 4% on $95,000, but it's almost $99,000 to your total loan amount. So you can see that as you put larger down payments down, the insurance premium drops as a percentage. So sometimes for some of our clients, we look at, well, what's the best route to take here? Should you do 5% down or 10% down? In many cases, you see there's a big jump between 5% and 10% down, not so much of a jump between 10 and 15% down. In fact, what I find a lot of our clients will do is if you have the means to do it, 10 to 15% down doesn't make a lot of sense, but 10 to 20% down it makes a lot of sense, because now, instead of you having to pay the CMHC insurance premium, you also get the ability to go from a 25-year amortization maximum to a 30-year amortization, and that drops your payments quite a bit. And so, in some cases, if you're close or at the 20% down mark, it may make sense to consider doing 20% down. And I should also note this too. This is a very common misconception. You do not have to be a first-time home buyer to buy with as little as 5% down. You just have to be buying your own personal residence. So for some reason, people get this mixed up all the time, and they say, "Oh, I'm a first-time home, or I'm not a first-time home buyer, and so I have to put more than 5% down. I have to put 20% down." That's not the case. If you are buying your second home or third home, but you're buying your personal residence, you can do that with as little as 5% down. So talking about down payment, let's go through some of the traditional, non-traditional sources. And I'm going to explain what these mean. So traditional sources are the most acceptable. These are typically what lenders like to see. So your own savings, of course, that's number one. RSP withdrawal, totally fine. That's good. A non-repayable gift from an immediate family. This is very common, especially with the transfer of wealth happening from a lot of baby boomers and getting down to the kids, grandkids, et cetera, to buy their first homes. A gift is an acceptable source of down payment, and that is something that's very common and popular, especially in major urban centers. You can use the proceeds from another sale of another property, or you can borrow money that's borrowed against another secured asset, so other real estate that you own, for instance. So this is probably not as applicable to a first-time home buyer, but if you own a property already and you want to buy your next home, you can borrow against your current home to come up with your down payment for your next one. Non-traditional sources. So let's go into this very quickly. Borrowed funds. You can, with certain lenders and insurers, you can borrow your down payment. In fact, you can borrow, believe it or not, you can borrow your down payment on a credit card. Don't advise it, but if you have a very high income, but you just don't have the savings here in Canada for whatever reason, you can do a borrowed down payment. There is a special program for that. The CMHC premium is a bit more expensive, and it's very difficult to qualify for it. But you can actually borrow your down payment if you do not have your 5% down. A gift from a non-immediate family member. This can be tricky. Depends on the lender, and when we say immediate family, we should clarify too. Immediate family is typically parents. That's usually what the lenders want to see. If it's an uncle or an aunt or a sibling, it gets a lot more complicated, and in some cases, the lenders will not accept a gift unless it's coming strictly from mom and dad or grandparents, somebody that's above the family tree, so to speak, as opposed to something that's lateral on the family tree. Sweat equity, this is something that is basically impossible nowadays, but sweat equity used to be something that you could use for down payment, where if you put value into the property by doing work on a property before you bought it, sweat equity was an option, but sweat equity, frankly, is not something that I don't think I've seen or done one in probably 12 years, to be honest. It's not common. I don't even think it's an option anymore. Just like cash back. So up until 2013, we used to be able to use cash back as a source of down payment. So you would get 5% cash back at a higher mortgage rate, and you would use that cash back as your source of down payment, which is no longer an option. So these are the different options you have to fund your down payment. Closing costs is another important key to need to understand is how much money you're going to need at closing. So the most important thing that you need to look at is if property transfer tax is going to apply. In BC, anyways, it's 1% of the first 200,000 and then 2% of the balance. So if you're not a first-time home buyer, or let's say that you are a first-time home buyer where you're buying up to 600,000, where you do have a property transfer tax expense, you'd be paying $10,000 in property transfer tax, plus the legal fees of about $1,200 to $1,500. Plus, there may be adjustments at closing. So depending on when you buy during the year, there can be adjustments like, did the current owner already pay for the entire year of property taxes and you have to reimburse them or not? So there's a lot of different things that you have to look at on the adjustments. Typically, they're not as high as $2,000, but sometimes they are. As a first-time home buyer, you should be, even if you're not paying the transfer tax, you should have a couple $1,000s set aside. A good rule of thumb is that you should have about 1.5% of the purchase price in extra cash. And you don't really want to be buying a home and having no cash in the bank, right? It's a good idea to have some extra cash. So that means that if you're buying a property for $500,000, ideally you should have about $7,500 set aside for closing costs and just set aside to have a little bit of a liquid cushion for a rainy day or a rainy month. Now, if you've got this figured out and you think, yes, you know what, I think I have enough money to buy a home, I have the money set aside for closing costs, etc. let's talk about what the process of writing an offer looks like. Because if you're pre-approved, you're starting to go shopping, you've got your money, your down payment saved up, what do you do next? So your realtor would take you shopping, go out and start to look at, hey, where is a good place that fits your budget and lifestyle. If you see a home that you like and you're already pre-approved, then what you're doing is you're writing an offer. And so you write an offer to the seller and you say, this is the price and these are the conditions and subjects. And then usually it takes about 1 or 2 days before the seller gets back to you for acceptance. Sometimes it's shorter than that, sometimes it's longer than that. Normally it's no more than 24 hours in my experience. Now, as soon as you get an accepted offer, you have to tell your broker right away. Make sure that you let them know and say, hey, I've got an accepted offer. What do I do now? What information do you need from me? Keep in mind that even if you're pre-approved, that some of your documents may be stale dated. So if you send us your pay stubs 3 months ago, the banks will probably want to get some updated pay stubs to verify that you are still working at the same location and you're still making the same amount of money that you used to make. So it's important that you get in touch with us at minimum when you have an accepted offer. It's even better if you think that you might be writing an offer on something to involve us and say, hey, look, I might be writing an offer on this on the weekend. Is there anything I need to get refreshed for you so that we can make sure that we're all in the clear? Due diligence. This is very important that you start your due diligence right away too. There's a lot of things to review and a lot of things to dig into and make sure that this is the right home for you. So one of the important things, especially if you're buying strata properties, that you need to start reviewing the strata documents ASAP. There's a lot to go through, and I'll be getting into actually a little bit of the due diligence specifically on what documents you're going to want to be looking at. Arranging an inspection, you either arrange it ASAP or you try to line it up so that the inspection happens after you have your financing approval. So if you're expecting your financing approval to happen in 3 to 4 days, then you'd want to line up your inspector for 4 or 5 days later on. An inspection is really important. I don't generally recommend somebody buys a property without having an inspection. An inspector will go into the home and determine whether they think that there's any work that needs to be done. Is everything working properly? Is there mold in the home? Is there any water ingress or water problems? These are all things that are very important for you to understand, especially if there might be upcoming work, and especially in a house. How old is the roof? When will I need to replace that? Those are all things that are really important. So once you've met all of your requirements, once you have your financing approval and inspection, reviewed all the documents, that's usually when you're removing your subjects. And that's usually in most cases, and I'm going to say most cases, it's usually about 5 business days to 10 business days after you wrote the offer. Depending on the market, that's kind of the norm. Obviously, in a seller's market, you're writing much tighter dates. And in a buyer's market, you can get away with longer dates because there's way less buyers out there in the marketplace. So just keep that in mind that the timelines do vary depending on the type of market that you're in. When you remove your subjects, now you have to provide a deposit check. A deposit is not the same as down payment, although it can form part of your down payment. And so sometimes a deposit can be smaller or larger than the amount that you're going to use for your down payment. I find that in most cases, a deposit is about 3% of the purchase price, although that can really vary. Whereas your down payment is typically minimum 5% down. And so what happens is that deposit check that you provide will form part of your down payment, and it'll be a credit towards all the money that you need to bring in at closing. Sometimes, if you're trying to access money out of an RSP for your down payment, you might not be able to get access to the money in time. And so you can use quick cash to do for the deposit, even if you intend on using the RSP for the down payment. And sometimes you can even use a line of credit or some kind of credit that you have available to provide the deposit, because again, you're getting a credit back on those funds at closing. And so it's kind of an in and out transaction. Once you have done this, then you're just waiting until you get to move in. So, and I'll talk a little bit about the closing process in a second. Let's talk about due diligence, because this is important too. What information should you be reviewing when you have an offer on a property? So if it's a strata property, you want to make sure that you're getting 2 years of the annual general meeting. So those are the AGMs they're called. And that's a pretty high level meeting minutes. They go into a lot of detail. They go through the budget for the strata and a number of different things. That's usually one of the most important things you want to look for. There's also 2 years of the strata minutes themselves. Some things that you want to look for in the strata minutes is, what is the strata bringing up? Are they complaining a lot? If you like to play loud music, you probably want to be checking in the strata minutes to make sure that you don't have people that are complaining all the time about how noisy it is and how 60-year-old Aunt Lori can't get her sleep at 3 o'clock in the afternoon on Sundays because the neighbor's playing their music too loud, right? So make sure you check on things like that. Or parking is a big thing. Are they complaining about the parking all the time? Maybe there's not enough parking in the area. So there's a lot of little things that you need to look into and figure out. The strata form B is very important. Strata form B will basically say, how much does the current owner owe the strata? Is there any upcoming special assessments that you know about? Is there any pending litigation against the strata? There's a number of different things that they would look for. A most recent strata budget, something that you want to check out. See how much money is in the contingency reserve fund. See if they're well funded for all the work that's going to come up. And property disclosure statement or depreciation report in BC. Those are things that are very important too, because they'll look at what work is going to be coming up on the property and how will it be funded. So very important things to look for in strata properties. If it's detached, you want to see if there's a survey available. A survey basically looks at where is the home situated on the piece of land. And so sometimes it can be determined that a fence might actually not be on your property, it might be on the neighbor's property, which means that if the neighbor finds out, they might say, hey, you have to rip out all of your fencing. So that's something that you would want to take a look at if a survey is available. This is becoming less and less common, but certification of oil tank removal. So in certain areas, oil tanks still have been in the grass on the property for a long period of time. It's really important that the oil tank has been removed. Oil contamination can be a major issue, and if you buy that property, you're assuming all of that risk, and so you usually want the seller to verify that there is no oil tank on the property. It's been quite a while since I've seen an oil tank that has to be removed, but here and there it's still a thing. Make sure you get receipts and warranties for any major repairs that have been done to the home, roof, furnace, etc., and permits for various work done. There's one other item too that I should mention. Is there's something called a property disclosure statement for detached too. It's not just for strata, so it's called the PDS, and that is basically a checklist that the seller fills out that says, do I know of any marijuana grow ups? Was any work done without permits? Things like that. So it's an important document to review. So when you get to closing, I won't go through the nitty gritty of what's on here, but you'll be meeting with the notary or lawyer just about the week of closing. So if you're closing on a Friday, you're probably going to go see the notary or lawyer on Tuesday or Wednesday, and that's when you're going to bring in your ID. You're going to review and sign a bunch of paperwork. And yes, if you thought that you had to go through a lot of paperwork to get the mortgage, guess what? There's way more at the lawyer's office because that's where you get to sign all the legal stuff. Fun. So you'll be signing legal documentation at the lawyer's office, usually the week of closing. That's where you're going to bring in any extra money that's needed to close. So they'll look at all the debits and credits on the transaction, how much money is needed in order to fund this, and they'll let you know how much money you need to bring in order to close. Insurance. This is something that gets forgotten about all the time, is you do need a home insurance, especially if you're buying detached. You need to make sure you have home insurance. In fact, the bank will not lend on a property that does not have at minimum fire insurance and sometimes earthquake insurance as well, depending on where you're at. So something you need to check out and look into. If you can't get insurance on the home, you might not be able to get a mortgage on the home. If you're buying a strata property, then typically part of your strata fees go to insuring the shell of the building. And so you still need to make sure that you get contents insurance, because if there's a big flood or fire, things that are considered chattels, aka things that can be removed from the home, things like all of your appliances, all of your personal belongings, those are not insured unless you get your own insurance policy on it. So make sure that you have home insurance on your contents. Moving, of course, moving. So getting a mortgage, not very fun. Moving, also not very fun. But make sure you get your movers arranged in advance. We've had it before where clients have not organized their moving truck and they're trying to do that 2 or 3 days before closing. And in the middle of the summer, it's way too late. Now, make sure you're organizing your movers well in advance to ensure that you're not all of a sudden trying to borrow your friend's pickup truck and doing 8 trips just to move your house. Okay, so make sure you get a moving company organized in advance. And last thing is closing. So in most provinces, the closing date and the possession date are either the same day, or possession is usually about a day after. Not always, but usually there's a closing date, and that's the date that money exchanges hands. And then usually the day after is when you get possession, and that's when you get the keys. You get to actually go into the home, and that's where you get to move in and do all the fun stuff like getting all your friends and coaxing them to come over to your house and spend a couple of hours helping you unpack with some beer and pizza. So I'm going to go through a couple of tips and a couple of things that I see people, some do's and don'ts of buying, especially buying your first home. The first one that I want to talk about is the money out of nowhere RSP trick. So one of the cool strategies is that when you're taking money out of your RSP as under the first-time homebuyer plan, you can withdraw up to $35,000 out of your RSP. The money has to be in the RSP for at least 90 days before you take it out. But here's a cool trick, and it especially works if you're doing this right before tax time and you plan on buying sometime in the spring or summer. So if you put a bunch of money into the RSP right before tax time, you're going to get a big tax refund. So let's give you an example. If you had $10,000 in extra savings and you don't have $35,000 in RSPs yet, so you don't have to worry about pushing yourself over that $35,000 threshold. If you took the 10 grand and put it into your RSPs, depending on your tax bracket, so that depends on your income, and let's say that you're at 35% tax bracket, which is pretty common in Canada. If you put that $10,000 into the RSPs, on your tax return, you're going to get a return of about $3,500 off of your taxes. So you might now have $10,000 in RSPs and now $3,500 on the tax refund. So what you just did here is you took $10,000 you had in savings, you put in your RSPs, you go buy your home and you pull the 10 grand back out of the RSPs along with whatever you have in the RSP, but you still have $3,500 here. You've created $3,500 out of nowhere. Now, you still do have to repay the RSPs back over a 15-year period, but I can tell you, you're going to have a bigger cash crunch when you buy your first home than you are in 15 years from now. So it's well worth it to do this RSP money out of nowhere trick, especially if the timing is lining up. If you're trying to buy something in the fall and you're already starting to look in summer, may not make sense for you because you are not going to get a tax refund until the next year. But this is a really cool trick, especially if you're prepared in advance before tax season. Vehicle loans are a killer. This is probably the number one thing that I want to hit home today with all of you is that vehicle loans are a killer. So to put things in perspective, a $500 a month car payment will decrease your borrowing power by $100,000. Yes, $100,000. And here's the thing, you probably only owe $20,000 or $25,000 on the car loan. But as I said earlier, it's all about income and all about debt servicing. So the reality is the payment on that vehicle loan is going to be about the same as borrowing $100,000 on a mortgage. I've seen it before where people have a truck payment where the truck payment is of $900 or $1,000 a month. Well, there goes $200,000 in borrowing power. I'm sorry, Albertans, I see it all the time. That F-350, beautiful truck, but it really hurts your borrowing power. So sometimes we have the conversation, look, it's either a house or the truck. You can't have both. One thing I will mention is that it is easier to qualify for a car loan than it is to qualify for a mortgage. A lot of time we find that people, because you have to qualify under what's called the stress test when you get your mortgage, which means that using a rate of about 2% higher than your actual rate you're getting to qualify you, it can be hard for you to qualify at this higher payment when you buy your first home. In fact, just buying any home for that matter can be difficult. But once you're done, now any future subsequent financing, they're going to use the actual mortgage payments on your mortgage. So it makes it a little bit easier then to go and add a vehicle loan into the mix after the fact. And also on top of that, vehicle loan, they allow for higher debt servicing. So just make sure you order it in the right order. And reality is, what's more important to you? If getting the F-350 is super, super important, getting a home isn't, then get the F-350. It's all good. But if buying a home is the most important thing that you want to do that first and then figure out the car loan. And don't get me started on car loans because, it's sure a vehicle is an asset technically, but it's not good debt, it's bad debt. You're buying a depreciating asset and borrowing to get that depreciating asset. So it's not ideal, something that you really should be prioritizing buying the appreciating assets first and then buy the depreciating assets later. Unsecured debt's also a killer. So if you have money owing on credit cards, unsecured line of credit, anything like that, $20,000 in unsecured credit is the equivalent of borrowing $100,000 in a mortgage. And that's because the banks use about a 3% 3% of the balance payment on that unsecured debt. So it's a very high payment that's associated with it. So if you're preparing to buy your first home, make sure that you're getting that under control. So these are some cool tips and some very important tips on preparing yourself to buy your first home. Now, obviously, there's a lot to discuss and a lot to go through, and I don't have all day today to go through all the little nooks and crannies here. Obviously, it's if you have specific questions, you can book a consultation with us. You can go to our website, and there's a form that you can fill out there. As I wrap up, but today I'm also going to open up for some Q&A at the very end, and I'll hang out and answer any questions. But for any of you that would like to just book a call with us and go through your specific situation, happy to do that, of course. Make sure you check out our website. We do have upcoming webinars. I do a webinar on the first Wednesday of every month. The next webinar is how you can make over 20% returns investing in real estate. So something to keep in mind and check out for sure is our webinar that comes up on the first Wednesday of every month. We have a lot of downloadable spreadsheets. You'll find our rent versus own spreadsheet. You'll find a number of different spreadsheets on our website, FAQs. You'll also find our first-time homebuyer survival kit is on our website as well. A lot of the information and graphics that I was showing you today were actually taken from our first-time homebuyer survival guide. And so it's a 20-some-odd page PDF that goes through all of the little bits that you'll need on how to buy your first home, all the little bits that you need to be able to prepare yourself. So if you have any questions, feel free to contact us. Our office is located downtown. Website is greenmortgageteam.ca. Website or email is info@greenmortgageteam.ca. And you can reach us at 604-229-5515. I will open up for some questions now. I think we had a couple of questions in the Q&A, so let me open up those first. Okay, so I have a question. So you can put as little as 5% down, and is this only available for first-time home buyers? So the answer is that no, you do not have to be a first-time home buyer. You can be buying your own home, and you can put as little as 5% down for your first home. Just keep in mind again, it's 5% of the first 500,000, and then 10% of the remainder. There's also another question about how do you qualify for that 750 tax credit on your income tax return. So to qualify for the 750 tax credit, when you file your taxes next year, you just need to make sure that you let your accountant know. There is a little box that they tick off to say, did you buy your first home last year? And you get a tax credit. Again, this is a thing that the Liberal government did. They may or may not continue to do this on an ongoing basis, but as of right now, it is a tax credit that's available. And I have another question here. Is GST applicable on the property, and can the GST amount get added to the mortgage? So if GST is applicable, most lenders will lend on the net GST that you will pay. So GST typically, and it depends on whether you have a GST rebate or not, but the lender will lend on the net GST that you will pay, and that can get added to your mortgage. I have a question here. I think somebody has raised their hand. So maybe if you would like to just type out your question, then I'm happy to answer it. We'll put it in the Q&A, Sheehan. Oliver, can you speak a bit to the rules of principal residence? Are you allowed to rent out a house yet retain personal residence status? So this is a great question, Oliver. So if you're buying your own home and you're calling it a residence and you're not paying the property transfer tax, you're saying, yes, this is going to be my personal residence. Typically, you're supposed to live in it for at least 1 year. I've had it before where a client says, I'm going, this is my personal residence and I'm not going to pay the property transfer tax. I'm going to waive it because I'm a first-time home buyer. And what ends up happening is the government sometimes does audit people. And I've seen it before where the customer has been sent a bill for the property transfer tax in the mail. So it's really important that if you're saying that you're going to live in the property, you should physically move into it. And generally speaking, you should be living in it for about a year. Of course, personal situations can change and fluctuate. And if you can't live in it for a year, then you can move out. But at the same time, too, you need to make sure that you understand that you might get billed by the CRA for the property transfer tax if you do that. Dimitri has a question. So if you buy a pre-sale, how do you take, or do you take out the mortgage after the home is built or before? So you only get the mortgage once the property is complete. And so that's when the money exchanges hands, and that's when you fully fund the mortgage. However, you still should get the mortgage approval in advance. So if you're buying a pre-sale, you can get an approval, and this is where the lenders vary a little bit. Anywhere from most lenders only hold rates for 90 to 120 days, but some lenders will hold rates for 18 months or even longer until the completion date of a purchase. So that's where you can check with ourselves and figure what long-term rate holds are available for a pre-sale. Second question: if you buy pre-sale, can you use the mortgage to pay off the GST, which is required to be paid in pre-sales? So what would end up happening is the GST amount gets added to the purchase price, and the lender lends up to 95% of the total price, including the GST. So let's say that GST, you're not qualified to get a GST rebate. If that's the case, and you're buying something for $500,000, and there's a 5% amount added to your price, they'd lend on the total purchase price of $525. So you get 95% financing on $525. Last question: sometimes pre-sales ask for 20%, and so when you say 20%, that would be the deposit. Can you use the Canadian Assistance Program to pay 10% and pay 10% out of your pocket? So the Canadian Assistance Program is only for down payment, not for deposits. Keep in mind that the pre-sales are asking for 20% deposit, but they're not asking for 20% down payment. So there is a difference. You may need to see if you can borrow some money from friends or family to put up the deposit, but then when you close on the purchase and it's ready, and you're only doing 5% down, you'll actually get a bunch of that money back. You're going to get about 15% back, and you can repay whoever you borrowed the money from for your deposits, because the down payment and deposits are separate. They are different. Another question: so what's your opinion on buying the most expensive home you can afford? You know, it's an interesting question. I don't necessarily agree with it, but there is some credence to it. Here's an interesting thought experiment. So if you bought a more expensive home, let's say that you could either buy a townhouse or a detached home with a basement suite in it. And if you're really stretching yourself to buy that home with a basement suite in it, and maybe you had to spend an extra $100,000 to do that, but now you have a tenant that's going to pay you $1,000 a month. Keep in mind that on a mortgage payment, usually your payments are about $400 to $500 per month for $100,000 that you borrow. You're only going to pay an extra $400 or $500 more per month to borrow that extra $100,000, but now you're going to receive $1,000 a month in rent. So it may make financial sense for you actually to do it that way, and to be in a better position financially. Now, there is something to be said for the fact that there's a stress test, and the stress test will vary a little bit, but it's typically about 2% over the current interest rate. And the issue with the stress test is that it makes it so that you're not able to qualify for as high of a purchase price. And so it's probably, in many cases, very affordable for a buyer, and yet they can only qualify for a certain amount. So I find a lot of time our buyers are pushing the limits on what they qualify for, because their budget personally is much better off than what they have to qualify for because of the stress test. My recommendation is to look at things, and I highly recommend that you should be saving enough. You should be able to still put money aside and put that into liquid investments. Real estate is a great investment and a great asset class, but I don't believe that you should be putting all of your money into real estate, and I think you should be diversified. Another question, Katya has a question further to Oliver's. You live in your property for a year and then decide to rent it out. Will the lender have an issue with it? So Katya, your intention as of day one should be that if you said you're going to be moving into the property, then you should move into it. So if it's called a personal residence, then you should be moving into it. If you decide to move out later on, 6 months, 12 months later, the lenders are actually okay with that, as long as you intended on living in it and you did in fact live in it. Intentions can change later for many different reasons, and so the lenders are okay with that. But you do have to keep in mind that the banks don't like to see that, and it's more of a government issue than it is a bank issue. In fact, you can buy a residence and then a year later refinance that residence now and turn it into a rental, and then take out the down payment and then use that to buy another residence for yourself. So now you're turning a property that the lender financed for you as a residence, and now it's going to turn into a rental, and the lenders are typically okay with that. But you do have to usually show that you actually did move into it. Ronald has a question. I'm trying to plan for expenses. Is the condo insurance premium crisis still happening, or is it solved yet? Example, rapid increases in premiums. So the crisis is, for the most part, now it's worked its way through the system. So most stratas have now had their insurance renewal come up. And so you should be seeing now that the strata fees in most strata buildings are now accommodating for the insurance costs that have gone up. And insurance costs have gone up anywhere from 30% up to 100% more, or even 200% more in some cases, extreme cases. So yes, condo insurance has gone up. Insurance in general has gone up, but especially condo insurance. But nowadays, if you're looking at strata fees, the strata fees should, for the most part, be accommodating the increase in the cost on the strata insurance. Another question, any word on the rumor of taxing personal residence capital gains? So capital gains as a tax based off of the appreciation of the asset. If you buy a rental property, any appreciation on the asset is taxed at the capital gains rate. As of right now, your personal residence is taxable, is not taxable for any capital gains. And so it's basically tax-free money that you earn. There is very minor talks about this, I'm hearing anyways. I think that we're still a ways away from them releasing and going into this, and I think that that's a pretty aggressive move. But at the same time too, there are some rumblings, and I know some of the banks are saying, hey, government, maybe you should be implementing this. So in my personal opinion, I would be surprised if we see it in the short term, but we might see it in the long term. It is a factor down in the U.S., but at the same time, the U.S. also allows you to write off the interest portion of your payments on your personal residence, which I always thought was a bit odd too. It encourages people to go and buy the biggest home they can for their personal residence, which I don't see Canada doing. So yeah, it's possible, but I don't think it's extremely firm at this point that would happen. But I could see it possibly happening sometime. Is there a link to the rent-to-own spreadsheet? Yes, I will. I'll send over some information. And by the way, what I'll do is after the event here, we'll send out an email, and we'll just attach it to the email for all the attendees. As I've had a couple of people ask for the document, so I'll send it over to you guys. Katya has a question. So if an aunt or uncle wanted to provide a gift for down payment, would it be a good idea to make the gift a few months in advance of the recipient's property purchase? Would that be more acceptable with a lender? Yeah, so in general, lenders like to see that the down payment is in your bank account for 90 days prior to the application date. So if we're applying today, they're going to go look backward to 90 days and see, has the money been sitting there for 90 days? Having the money seasoned in your account now leading up to the purchase date is a good way of avoiding any potential issues if gifted money is coming from a non-approved source. Again, many lenders are willing to consider and are okay with an aunt or uncle, but if you can pop the money into your bank account and completely avoid the issue, it is better. And keep in mind that if your file is tight in any way, a gifted down payment instead of money that's in your own resources, in your own hands, is a slightly weaker application than if you just had it in your own pocket the whole time. So I would recommend, if you have the ability to, get money in your own hands sooner rather than later. John has a question. Are you finding the appraisals coming close to purchase prices? I ask because there are bidding wars and some are overpaying. So interestingly, John, not that many issues that I'm seeing. I'm finding that in most cases, the appraisers are usually finding a way of coming up to the valuation. I would say probably about 5 or 10% of the time there are issues. It's not very common though. The interesting thing is, it seems like every new purchase is setting the new benchmark, the new precedence for valuations, which is interesting. So one of the things that I've been noticing, however, is appraisers sometimes, if they're having difficulties matching the current climate, they look at comparable properties, so 3 to 6 properties that have recently sold that are comparable to the one that you're buying. And they make adjustments. So they say this house is bigger than yours, and so it should be valued more. But the property, maybe the lot is smaller, and so they'll adjust downwards, and they make adjustments and they determine what each property would be worth compared to just yours. One of the things that appraisers have in the tool belt is a time adjustment. And so if a property sold a few months ago in a hot market where values are rising, they can say, well, this home sold 3 months ago, and therefore I'm going to do a time adjustment because the market in general has appreciated since that purchase was made. And so this is a little thing that I found appraisers have in their back pocket that they're able to use to make it a bit easier to meet some of the valuations. And yeah, it's a bit crazy out there. We're hearing a lot of stories about people outbidding each other, you know, hand over fist and writing subject free offers. So yeah, it's a bit crazy. Jonathan's question: do you recommend fixed or variable interest rates? Good question. I would say that most of our real estate investors are going variable, and well, yeah, probably most of our first-time home buyers are going fixed. And so we have a bit of a split here in our office. I would say that in general, most of our clients would go variable. The variable rate is more flexible, and so the three primary reasons why most of our clients would go variable is that number one, in general, variable rates have outperformed fixed over an extended period of time. You do have to look at what the trend has been in the last 25 years, and the trend has been interest rates have been doing this. And so, of course, in an environment like that, variable rates would outperform fixed. And it seems like we're always thinking, oh, how much lower can they possibly go? And then they go lower. So it's an interesting thing. But I think that overall, aging demographic, there's a number of reasons that I think that that interest rates will stay low for an extended period of time. And so that's one reason to consider variable. The second reason, and probably the most important, is the penalty cost. So if you're in a 5-year fixed rate mortgage with a major bank, your penalty is either 3 months interest or what's called an interest rate differential penalty. It's the difference between your rate and current market rates for the same term remaining. That sounds simple enough as it is, but the problem is that they manipulate their posted rates in a way where this penalty calculation is very unfair. So a lot of the time when we have a client that's getting a fixed rate, a 5-year fixed rate in particular, we'll typically use a non-bank lender because they don't have posted rates, and so their penalty calculations are much more favorable. Whereas a major bank, I find that the IRD penalties are 5 to 10 times more expensive than it would have been if you were with either a variable rate or a non-bank lender for that. So that's the big reason, especially in today's climate. A third thing, it is more flexible in the sense that you can convert and lock it into a fixed rate at any point in time into whatever the fixed rates are at that time. And so if 6 months into the variable, you're starting to freak out and worry that interest rates may start to rise, you can call up that lender and get a quote on what the rate would be to lock it in. We always recommend that you call us first and figure out what's actually happening in the marketplace. I've had clients call the bank and they say, "Oh, rates are going up. You should really lock in the mortgage." And then they call me just to double check, and I say, "No. I know for a fact that same lender is dropping the rates tomorrow because their rep just sent me a message saying their rates are dropping." Or bond yields, which is a great indicator if you're ever trying to follow where fixed rates are heading. Watch bond yields. If bond yields go down, fixed rates are probably going down. And that's a good way of looking at it. So if bonds are going down, and sometimes our clients will call the branch and they say, "Oh, you got to lock in, fixed rates are going up," and it may not be true. One important key is that banks actually make more money off of fixed rate mortgages than they do on variable rate mortgages. Their margins are bigger. And if you've ever gone to a bank to get a quote on a mortgage, it's a lot of the time you go in there and say, "Yep, here you go, here's your rate," and they just quoted the 5-year fixed rate. They didn't even quote the variable rate. It happens all the time. And the primary reason for that is the margins are thicker. The branch employees are taught to sell the 5-year fixed rate. We like the flexibility of the variable rate. We see it enough times where clients get stuck with massive penalties that they're very expensive to get out of. And we actually had one recently where the penalty cost was the remaining amount of interest on the mortgage for the last 1.5 years of the term, which is absolutely crazy. So it can be very expensive to break a fixed rate mortgage. So that being said, for first-time home buyers, the likelihood of you breaking that mortgage is lower than a investor, for instance, who's refinancing and redoing mortgages and maybe selling the property or whatnot in a couple of years' time. So there's less of a likelihood of that. And I know for first-time home buyers, there's a preference in general to know exactly what your budget is on a monthly basis. But I would say that most of our clients would go variable, and I think that's because of the flexibility aspect. Good question, John. And Katya, thanks for the information. Good answers. Thank you. Appreciate it. Awesome. I'm just going to see if there's any other questions. And let's see here. Yeah, I've got another question here. Let's go this here. Okay. What is the definition of first-time buyer? If you're sort of inherited your principal residence and you want to buy a new home, can you be considered a first-time home buyer? So good question, William. In order to be a first-time home buyer, you have to not have owned property. And there's two actual definitions. So The first one is for the RSP homebuyer plan, and the other one is for the property transfer tax. For property transfer tax, your name can have never gone on title of any real estate. So if you're trying to avoid the property transfer tax, the fact that you may have gone on title of a home may disqualify you. If it was a family home or something like that, maybe talk to a lawyer. There might be a way that you can get around it or build a case for it. If you are looking at the first-time homebuyer plan for the RSPs, where you can withdraw up to $35,000, you just have to not have owned a home for 4 years, and not have been on title for 4 years. So the definition of what is a first-time homebuyer actually varies depending on the two different things that you're trying to look at, which would be their RSP plan and the property transfer tax. Thank you. Good question. Awesome. Any other questions, guys? Oh, here we go. When someone comes to you before they start their property search, are you pre-qualifying the person to let them know how much they can borrow, or are you actually getting them a pre-approved mortgage? So, so good question, Christine. So typically what we're doing is in our office, we go ahead and we underwrite the file. We look at it and we say, this is how much money you can qualify for. This is your borrowing power. What we typically do is, in our office anyways, we usually send in the pre-approval if and when the rates start to go up. And so we always get a bit of a heads up and notification of, oh, rates are looking like they're going up. And so we actually send it in at that point in time, and right before the rates do actually go up. And the reason that we do that is that we buy ourselves more time. So let's say that rates don't go up for 2 months from today. If we send you in today for the pre-approval, the clock on that rate hold starts ticking today, and you will have today's rate for 4 months. If rates go up in 2 months, however, and we send you in then, we're basically getting today's rates for 6 months for you. So we typically don't send in for an official pre-approval until it looks like rates are going up. The reality is, in our office, we do a lot of transactions. We're one of the top brokers in the country. We know when a deal is going to work and when it's not going to work. We don't need a bank to rubber stamp something and pre-approve it for us, unless it's a bit of a unique deal, in which case we will ask the bank to underwrite it. But in most cases, a pre-approval honestly is not worth the paper it's written on, because all the banks are doing is we're punching it into the system, sending it to the bank, and then if the numbers meet their criteria in the system, they just go, boom, yep, here you go, here's your pre-approval, here's your rate, that's it. So they're not really digging into the file. The most important thing is they are not reviewing your documents. If you go into a bank and you ask for a pre-approval and the bank does not ask you for documents, you have to be a little bit concerned about that pre-approval, because it's probably worthless. You know, the number of times that the customer may say, hey, this is my income, and then we get the paperwork and it's not quite their income, it's a little bit lower, or there's something unique or different about it. It's really important that you're actually getting somebody to review and go through all of the documents. Awesome. Thanks, guys. Appreciate it. Thanks for coming out. Thank you. Any other questions, guys? Anything else you guys would like to ask me? What I'll do is I'll type in our website here, www.greenmortgageteam.ca. You can go there. There's a lot of materials there. And what we'll do is we'll also send all of the attendees today some more information. We'll send you over our first-time homebuyer survival kit, as well as our rent versus own calculator as well. So you can take a look at that and use that if you're looking at buying your first home. And thanks so much for coming out, guys. It was a pleasure to see you all. Thanks a lot, guys. Have a good night.